Hello, and welcome back to another Quick Byte presentation, brought to you by the Economic Alliance of Okanogan County. My name is Mason Duke, and today we'll be covering financial statements. Due to the nature of the subject, I'd like to emphasize that the contents of this video are provided for general educational purposes only, and should not be construed as financial advice. Over the past few months, we've used this series to introduce several key financial concepts. We've discussed how revenue is calculated by multiplying price times quantity, and explore the distinction between overhead costs and costs of goods sold, two categories of expenses that businesses are responsible for. We've also gone over how to identify gross profit by subtracting costs of goods sold from revenue, then subtracting the overhead expenses from the gross profit to finally arrive at net profit. Having the basic grasp of these concepts will aid you in understanding the financial statements we'll be covering today. There are three common financial statements that just about every business can benefit from: balance sheets, income statements, and cash flow statements. In today's presentation, we'll talk about each one in a bit more detail. A balance sheet is simply a means of visualizing what a company owns and owes at a single moment in time. It achieves this via the basic formula, assets equal liabilities plus owner equity. In other words, the funds a business has available to it are equal to the debt it has taken on together with the stake the owners have in it. Because of this, the two sides of the sheet should balance out, as we see in the example with both assets and liabilities plus equity coming out to $1,500. Generally speaking, less debt looks better on a balance sheet, especially to investors and lenders. They're looking to see who owns how much of the company and how much of a claim creditors have on company assets via existing debt. An income statement, also referred to as a profit and loss statement, displays incomes, expenditures, and overall profitability within a set period of time, typically a year. Unlike balance sheets, they are used to track changes over time, allowing for comparisons across periods and even against competitors. The document will look different depending on if your business uses a cash or accrual accounting system. The distinction basically coming down to at what stage revenue and expenses are recorded. The precise details of cash accounting versus accrual accounting may be the subject of a future installment. While similar to an income statement in that it displays changes over a period of time, the cash flow focuses on liquid assets, cash. Cash is critical to keep on hand so that a business can cover its expenses and continue to operate. Keep in mind that a business can be profitable but still run out of cash, maybe by having too much money tied up in inventory, investments, or other non-liquid assets. Cash flows can be compiled directly or indirectly, with the direct method often used by businesses that operate on a cash accounting basis, and indirect coupling better with firms that utilize accrual accounting. Like accrual accounting, the indirect method is more complicated and will likely require the assistance of a financial professional. That's all for today. Visit the SCORE website for free templates of these statements that you can download and use to track the financial health of your business. As always, we welcome any questions or requests by phone or email. Thanks for tuning in, and I'll see you next time.